Hey everyone, welcome to another episode of Brett's Brain. Today we're going to talk about the dynamic of break-even versus burn rate. Hey, I'm Brett, former entrepreneur, current venture capitalist. Thanks so much for checking out the channel. Make sure you share, like, subscribe. Our goal here is to help entrepreneurs succeed. So ask us questions. If we can help you in your journey, we'd love to be able to do it. Okay, burning cash is normal for many startups. There's also, especially recently, been a push to move to break even. How do you get to break even? How do you get to break even? What's your path to break even? Well, I think we've actually gone a little bit too far to the break-even side. And I want to talk about some of the dynamics between burning capital and the benefits and what can happen from burning capital versus moving to break-even and what can happen when you go to break-even. So let's start with the break-even side right now. So there's a big push in the market in the macro because it's harder to raise capital today than it has been for many years, that you got to get your company to break even, or you have to have a pathway to break even. Which is good because you control your own destiny. So if you get to break even, you do control your own destiny. You don't have to take term sheets. You don't have to raise additional capital. It's a little bit easier to get debt potentially. And you're in, default survive mode. And that's okay. Here's the downside of pushing to break even. When you push to break even, many founders don't have a plan of how you get out of that push. How do you maintain significant growth rates, or growth rates that are high enough that will keep your business exciting for you as the founder and for the capital and the investors that have already invested in your company? If you push to break even and then you don't have enough capital to actually continue to grow your company, or you don't have enough resources to continue to grow your company at a clip that is significant, not 10% or 20% year over year, that's just not significant enough to be an exciting venture backable type business at the early stages. If you don't have a plan of how to do that, then break even might not be the right choice for you. Getting to break even might actually kind of be a dead end where you end up running a company for years that's growing at 10% year over year. That's not that exciting for you because you're still relatively small and you've raised all this equity at that point. And so you're never going to be able to get out of your capital stack. You're not going to be able to get out of and have an acquisition or an exit that's exciting for you, the founder, or for your investors, frankly. And so if you're pushing to break even just for the sake of break even, it actually might not be the right decision for you. Now, if you can push to break even and you still have a plan of how you get to break even, but can then still double your business year over year, okay, that's a great plan also. And that might be something that you control your own destiny. You don't have to take term sheets. There's a lot of real benefits to that plan. But in the latter case that I talked about, where you kind of get there and then you're flat for years, a lot of founders get there and they're not happy doing it. So make sure you know what you're getting into. In many of those cases, it might actually be better to take the runway you have and the capital you have, shoot your shot. Try and go big for it. See if you can keep that momentum going, try and 3x your business. And if you don't, you fail and you run out of capital, you shut down. And while that's hard to do, and I understand mentally that's a hard thing to do, honestly, you might actually be better off as a founder where you can move on, start your next company and try and build again. It's not always the right move to try and shoot for break even. It can be the right move for a venture-backed business to try and shoot for break even as long as you have that growth plan once you get there. Hopefully this was helpful. If you like it, make sure you share, like, subscribe, and ask us questions so we can help you in your entrepreneurial journeys.